Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
Tax planning with pensions. Wow, we love talking pensions. Our most watched video on YouTube right now today is about pensions, and it's all about how much is a pension worth. And you should go back and watch it if you haven't watched it yet. But what we talk about in that episode is how valuable a pension is. And if you have a pension, you should feel very confident because less than 20% of people have a pension today. And so the way we explain how much is a pension worth, well, it could be worth up to $1 million or more depending on how much you have coming in a month. And the reason why that's the case is because that monthly amount guaranteed for the rest of your life, if you live 20, 30 years, that's a lot of money that you're accumulating from that pension, right? If you're getting $50,000 a year and you get that every year for the next 20 years, there you go. You've got $1 million just from distributions from the amount that you have coming in. So very awesome opportunity if you have that, but there becomes a lot of planning opportunities, a lot of work if you have a pension. It's all good, but it requires you to obviously do a more advanced planning on your situation to make sure you're prepared and not letting the government get more of that pension than what you want them to, right? You've worked hard for it. Let's make sure more of that money is in your pocket and less than Uncle Sam. So that's what we're here to talk about today is how do we pay less taxes on our pensions over retirement? So let's first start off by talking about why is this an issue? Well, as you know, if you have a pension, let's just use that $50,000 pension, for example. If you have a $50,000 pension, you're already outside of the standard deduction. So the standard deduction is the amount of tax-free money that you have up front. So if you're married filing jointly, it's close to about $30,000. If you're single, it's about half of that. And so if your pension is $50,000, you've already used up all of your tax-free income that you can, and now you're starting to force yourself into the tax brackets. Now, if you only have $50,000 pension and you're married filing jointly and that's all you have, well, you're in a pretty decent spot. You're not going to be paying that much in taxes. But the problem is we don't often see that. Most of our clients have more than just a pension. They have Social Security on top of that. They have a RMD. They have investment withdrawals, right? And so if all of those things play together, now you're forcing yourself into a much higher tax bracket because you're already starting yourself not at zero, but at $50,000. So think about it. If you don't have a pension, you're going to start off at zero. And your Social Security and your investment withdrawals are going to start from zero on. If you have a pension, great. Now you start at $50,000 instead of zero. So you're already starting behind on the game, if you want to call it that. It's a great thing from an income standpoint, but it's not a great thing from a tax planning, and that's what we're here to focus on. So I'm not here to bash pensions. I think pensions are awesome. If you have one, great. Now I'm just talking about how do we best plan from a tax planning standpoint. But again, if you're $50,000 ahead, you're already in higher tax brackets than your Social Security and your RMDs that most people have. Instead of using up that standard deduction with that money, now you're already forced to be in higher tax brackets with that money. So that's the main concept that we're going to be talking about. And also, most pensions are going to be guaranteed for life, so it's not going to get better for you. And if tax rates go up, as most people expect, it's not going to be easier from a planning standpoint. So that's the biggest thing there. The other thing to understand is Social Security. So if you're starting at that $50,000 versus $0, you're now already forcing Social Security to become taxable, and then any RMD withdrawals on top of that, Social Security on top of that, you're most likely always going to force Social Security to be fully taxable, which is 85% of it would count as income. And again, Social Security does not have to be taxable for people who have planned the right way. So now that you're already forcing it to be fully taxable, you're not going to get as much of that benefit, and so you're going to lose a portion of that. Which just may not be advantageous for you. And because it now counts as income, now you're forcing, when you take out investment withdrawals, those RMDs, required minimum distributions, when you turn 73, you're now forcing those to be at a much higher income because now you have your pension, you have your Social Security, and now you're going to force your RMDs to be at much higher rates and unknown rates at that, as I've explained earlier. So that's why this is so severe. The other consideration is Medicare Tiers, right? So if you have your Social Security, you have your pension, you have your RMDs, that's ultimately going to force you to pay more in Part B Medicare premiums. So let me talk through how that works. So Medicare Part B is based on your income. The higher your income, the more you have to pay into Medicare. Now, you get the same coverage as someone down the street who pays the bare minimum, but because you have higher income, you have to be forced to play that way. And so we typically see with people with a pension are finding themselves in those Medicare tiers very easily, very quickly. And so we need to make sure we're doing some planning now to lower their income over time, so that's less of a concern. And so I really just want to emphasize this next point I have. I've already said it a couple of times, but again, it's just that, do you think tax rates will be higher or lower in the future? And if you think the tax rates are going to be higher, as probably 99% of the people I talk to say, well, would you rather pay the taxes now or later? You've probably heard the age-old myth in my mind that you'll be in a lower tax bracket in retirement. Is that true if you have a pension? It could be, but for most people we see it's definitely not the case. They're actually in higher income situations in retirement because of all those things we talked about. Pension, Social Security, and RMDs, they're going to be much higher positions. So we work with a lot of federal employees. We work with a lot of retired military, a lot of retired state employees who have these great pensions. And then all this stuff on top of it typically doesn't leave them in a lower tax bracket. Remember, you're part of the 20% who have a pension now. You're in a different planning world, a different world of that. And also, if you are looking for guidance for someone to help you with this type of planning, make sure you're working with a team of advisors who understand how to deal with pensions and retirement. If they're just working with people who've never had a pension, they may not have the processes in place to best plan for you or the strategies in place to make sure you have the best plan in place. So our advice is to make sure you're working with someone who really understands your specific situation when it comes to pensions and how do they work together. So, for example, if you're a federal employee, make sure that you work with an advisor who understands federal benefits, who understands FERS and CSRS and all the different language that you need to understand, TSP and FAGLI and all of those, right? Or if you're working with, or if you're a state employee, making sure they understand deferred comp, making sure they understand, the survivor options on your pension, the PLOP, partial lump sum option, making sure they understand how to speak your language is the biggest thing that you want people to understand, right? If you're retired military, do they understand how the spousal benefit works? Do they understand your TSP? Do they understand that your TRICARE for life is going to be an awesome healthcare benefit and there's ways to plan in addition to that to make sure everything is good to go? So again, just making sure you're working with someone who is specific to your needs is the point I want to make there. But anyways, back to my thought about tax rates being higher in the future. So I actually wrote an article. It got featured in Kiplinger, and the title was, "Will you pay higher tax rates in the future?" And it was actually I was able to prove that, you will be paying higher tax rates in the future for most people. Not everyone, but if you've been a diligent saver, if you have a pension, if that's your situation, you will most likely pay higher tax rates in the future. And then if they're going to be at higher rates, again, that may be a concern. So that's what we're looking at there. The other consideration that I want to discuss here on the podcast today is survivor planning. So if you have a pension, and let's just say you chose 100% survivor option. You may have chose 50%, you may have chose none. But if you chose 100% survivor option and you get a full pension and your spouse gets a full pension when you pass, my question is what happens to the tax rates? You go from married filing jointly to now single tax rates. And if you know anything about those differences, basically your tax rates are almost going to double. Your standard deduction is going to get cut in half. The tax brackets are going to shrink, which means you're going to be paying about double the amount of taxes just from being single versus married filing jointly. And think about it. If they get 100% of that pension, they're going to be paying way more money in taxes on that money because now their brackets have shrunk, right, versus when they were married, but they have the same amount of pension income, right? They may lose one of the two Social Securities, but they're still going to have the same investments and they're going to have the same pension. And so if that's the case, you're going to force your spouse to be in a much higher tax rate. And so what we can do in those situations is let's look to lower those investments, right? Do things like a Roth conversion where you move it from tax deferred to tax free so that when your spouse goes to take out that money, it's going to be tax free. And so there's a lot of different strategies like that to best plan for that. So you just want to be very aware. We call that the widow's penalty. I've written another article that got featured in Kiplinger on that. We've done some other YouTube videos on that. And so that's just an important one to make sure you're planned for there. So let's talk about some now. Let's transition and just talk about how we're going to plan for this, right? I mean, it's enough for me to scare you all on how severe from a tax planning standpoint this is. But all the listeners, you guys want answers, right? How do we get you some answers to lower your tax burden if you do have a pension? So I've already talked about this strategy, but it's called a Roth conversion. And this is something we typically do with a lot of people with pensions. And with them, I would say it's more important for people with pensions than just about anyone else because, again, you're not ever going to be in a lower tax bracket. We've got to look to pay it now versus later at higher rates is ultimately the idea. So when you look to do a Roth conversion, let's back up and talk about what a Roth conversion is. And just to clarify, Roth conversion is when you take money from tax-deferred 401k, an IRA, TSP, deferred comp, 403b, and you take that money and you move it to a Roth IRA. Now, in doing so, you got to pay your taxes now, but the idea is, do you want to pay it now or do you want to pay it later in the future? And so that's the idea of a Roth conversion. So why does doing a Roth conversion make so much sense with pensions? Is because do it now before Medicare Tiers. Do it now before Social Security, before you start Social Security. Do it now while tax rates are lower versus later when they're higher. Or maybe you already are on Social Security. Maybe you're on Medicare Tiers. Well, do it over the next 3, 4, 5 years, however long you need to do based on how much you have saved up, so that you may have to pay more on those things today, maybe for 1 year, so you don't have to pay it more on it ongoing. For example, Medicare Tiers. Let's say that you blitz the Medicare Tiers, you have to pay way more this year, but that may lead to a 1-year problem versus an ongoing problem. So you have to really weigh the benefits of doing those types of strategies. So that's what we really want you to consider if that's you. Another way to plan for pensions, and this would be for those who have not taken their pension, maybe they're still working and they're going to have the option to take their pension. A lot of companies right now are offering lump sum options, and this could be a full lump sum option or it could be a partial lump sum option. And what this means is they will give you money that you can take today and you can invest into an IRA, for example, on your own, and you may get a lower pension moving forward. Now, do we advise this or not? It's going to depend on what the numbers show. So we run a lot of in-depth reports and analyses on people who have this option to see. Basically, what we look for is, can we take this lump sum of money and can we invest it in something that is going to give us a higher projected return, give us more income than what they currently get from their pension. So for example, let's say that someone had the option to take out $100,000 from their pension. If they did that, let's say it lowered their pension benefit by $100. And I'm just being very hypothetical here. I have no idea if these numbers are realistic or not. Just trying to give you a concept. So what we're going to look at with that $100,000, if we were to take that, is can we invest that $100,000 in something that can get us more than $1,000 a month of income? That may be one consideration we look at. And so if that's the case, which one would you rather have, this one or this one? You want the one that gives you the most, right? And so that's one consideration we look at. But we also look at, hey, what if you have the pension and you have no survivor option on it? Well, you pass away, your spouse gets nothing, your kids get nothing. If you were to take that lump sum and you were to put it into an outside investment, now if you pass away, there's going to be something left for that spouse, for those kids that they can now have in their name versus the pension just going away. So that could be a consideration of it makes sense that we would look at for many people. So if you have that option, look at it. Again, I'm not telling you to do that. I'm just telling you to really make sure you run the numbers, because right now today, we've seen a lot of people really take advantage of that and be able to better position their plan moving forward. So that's one consideration. And the next thing I want to consider on your options with a pension, if you have not taken it yet, is understanding how that survivor option works. So with most pensions, you have to basically pay for your spouse to be able to receive something in the future. So for example, let's say you're $5,000 a month pension benefit, and if you want to give your spouse 100% survivor, that could cost $1,000 a month. So now you're only getting $4,000 a month for the rest of your life. And then if you pass away before them, they would get that $4,000 as well. But the problem with that is what if you live till 90 and your spouse lives till 80? Well, now nothing's paid out, right? Or maybe you live till 90 and your spouse lives till 95. Well, now there's only 5 years of paid out, but you lost all that money from paying into that survivor benefit. So what we look to do with a lot of people is, is that worth it? And again, I'm not telling you it's not. We do that for a lot of people. It can make a lot of sense, especially if the spouse is 10 years older and much healthier. It can make a lot of sense. But if we're not expecting one spouse to live longer, or maybe we're not expecting, maybe we're expecting them to live about the same amount of time, Well, there's other options. You could not do the survivor option, save your money, get more now. Maybe you look to do like a life insurance policy just to cover any need there. Or maybe you're self-insured at this point and you can go without it and the plan looks good. You just have to really run your numbers in depth to see if that's an opportunity there. And another reason why it could make sense, I mean, this sounds terrible. I'm telling you not to take a survivor plan. And I want to make that very clear. I'm not saying that. I want to make sure the spouse is taken care of. That's their number one goal in planning for most people. But I'm just saying that it could make sense not to take it to get the higher amount. But also, now you're not leaving your spouse with a burden of this pension that he or she can't plan for because it's permanent. Versus maybe, let's say we took the lump sum or we took the extra money up front. Now we can start doing some tax planning now with that money. So maybe the spouse is still left with the same amount of assets or worth that they can plan for. We're just trying to do it in a smarter way now. So again, just a lot of ways to look at that. It's going to depend on your specific situation. But those are some of the strategies that we're personally looking at with a lot of our clients of how do we plan with pensions. And there's a lot more ways, but the biggest idea is just get help from that person that I mentioned earlier to really help you with your specific situation. So that's what I've got today on Joe Knows Retirement. Again, go back and watch that YouTube video. It's just a short 2-minute video, but it's gotten some really good traction, and I hope it can help everyone here. And just make sure that you continue tuning in here, and we'll continue to keeping the content coming so that you can live that retirement that you dreamed of. Enjoy the rest of your day.
Since we do not know your specific situation, none of this information can serve as tax, legal, insurance, or financial advice and may be outdated or inaccurate. The information comes from sources believed to be reliable but cannot be guaranteed. This content is prepared for educational purposes only. If you need advice, please contact a qualified CPA, attorney, insurance agent, financial advisor, or the appropriate professional for the subject you would like help with. Peak Retirement Planning, Inc. is an Ohio-based registered investment advisor and able to offer advisory services in Ohio and in other states where registered or exempt from registration.